about that all day yesterday.
24 seconds away from the opening bow this morning. Good morning to you as we kick off a brand new trading week stateside, and Europe takes an extra day off. I'm not bitter at all. Futures down 1/4% on the S&P. On the Nasdaq, we're down about 0.2%. With the opening bow in New York City ringing. Switch at the board and get to the bond market. What a move it's been so far in April in the Treasury market. Yields higher, much higher on a 10-year. This morning, just a little bit lower, down a basis point to 281.62. In the FX market, euro dollar 108.03, bit of euro weakness out there, down 0.1%. A lot of yen weakness recently, 12 straight days of it, a record run for dollar yen the last time I looked this morning. WTI crude 108.29, positive 1.25%. Around the open, energy up by 0.75%, the S&P down by 0.2%. Just looking for the financials, bottom of the pile, down 0.6%, with Bank of America and that stock price performance and a whole lot more. Let's get back to Shanali. Hey, Shanali.
John, if you're looking for loan growth, you're looking for it not just among the consumer businesses, but also in the commercial businesses. So if you're looking at the trading business, financing is actually one of the things that drove equities trading to a revenue over at Bank of America. But if you look under the hood here and you look at how much consumer loans are growing relative to commercial loans, it's only a 4% growth in consumer relative to a 16% growth in commercial businesses here. So there's a huge disparity among what you're seeing in terms of the overall jump at the consumer level. And that's the part that investors really want to see moving higher. You're not going to get a value multiple here for a volatile trading business here. It's the slow and steady NII growth, and Bank of America is taking those questions now on how sticky that NII growth can be in the face of a tough macro environment.
The CFO speaking at the moment, Shanali, levered to rates going up from here. I'm sure the business is. Yeah. At the same time, we get a headline from the World Bank cutting the 22 global GDP growth estimate to 3.2 from 4.1%. That is a chunky cut to the outlook. Are they speaking to this at all? Rates will help, sure, we get that. But this market at the moment seems to be very focused on the growth story going forward.
It certainly is the first question they got on the call. And what Bank of America is trying to say, they're trying to caution that the American consumer is still very flush with cash. And that should help stave off some of these worries about a slowing economy. But at the end of the day, what does that mean for loan growth? Because they're not going to generate much more revenue unless people keep borrowing. And right now, as they have been saying, the consumer is flush with cash.
Shanali, just fantastic work. I'll always repeat that every single earnings season around the bank. Shanali Basak there, our Wall Street correspondent, our chief correspondent on all things Wall Street. So the World Bank, here's the number, just to go through it again if you missed it. The 2022 global GDP growth forecast cut to 3.2% from 4.1%. We'll build on that a little bit later through the week as well. I want to talk about Twitter. I missed last week and I was jealous of not catching up with Bloomberg's Ed Ludlow on the West Coast. Twitter up today in early trading by almost 2%, approaching 46. Ed, what's the latest?
Yeah, you like your Elvis, John, because we had a tweet shock from Elon Musk quoting Elvis' 1956 ballad, Love Me Tender. Is that a sign of things to come, a tender directed to share offers? We'll see. You see we're flat right on the NASDAQ 100. Technology stocks coming off their first weekly decline in a month. Last week, or another way to look at it, we're coming off the drop we saw Thursday going into the long weekend. You see ARK Innovation ETF softer by 1.3%. Some of those higher multiple names, big tech names, some of which are due to report earnings this week, perhaps suffering. Twitter a main focus and gainer on the S&P 500 in the technology sector. This is where we're at, right? A consideration of the pace of Fed tightening. Come with me into my Bloomberg terminal. Look at this. The US 10-year yield is at its highest level since the end of 2018, right? We're considering the outlook for inflation as yields rise. Tech stocks have dropped off in recent sessions and recent weeks. The question is, are we heading for recession as we enter a very key earnings week across big names in the technology sector? We're looking for signs of outlook of consumer strength, but also what an ongoing impact of higher input costs is and the supply chain. And you know, these are names that we're looking at, John. It's relentless and it comes thick and fast. You start with IBM, Netflix Tuesday, you move to Tesla on Wednesday in consideration of the situation in Shanghai, plant shut down with what's going on in COVID, and then the social media landscape. Snap, really interesting. Don't often pay as much credence to Snap earnings. Will this week though.
Ed, looking forward to it, and we're going to catch up with you again in just a moment to have a deeper dive on what's been happening with Elon Musk and with Twitter as well. So let's go through it together. So tech's been struggling year to date, we know that. The banks have been struggling even with the higher rates. And Mike Wilson and Morgan Stanley wrote this, and I think it's important to go over just the data on what's been happening. The D-rating has been most severe in the expensive and or economically sensitive areas of the market, while defensive areas have actually seen multiples expand. So we've got this defensive bias gripping the equity market year to date. Taking a look, here's Taylor Riggs.
John, it's so interesting. The theme that we've seen in the last few weeks has been the theme, as you mentioned, year to date. Energy, of course, the big outperformer, up 45%, up 3.5% in the last few weeks or so. Take that out, everything else, like you said, pretty defensive, right? Staples, utilities, typically a big outperformer when yields fall, sort of that safe haven. Some of the big outperformers, not only in the last few weeks, but again, massively for the year. I think it was interesting that you mentioned Mike Wilson, of course, over at Morgan Stanley, and sort of uniting on this key theme when it comes to some of the strategists over at Bank of America. And you think about sort of the healthcare sector, maybe a more traditional sector, seeing massive inflows really here for the last few weeks as well. And as you can see here on your terminal, the outperformance that has been massive, yields higher, but not really sort of the financials and not really technology, as you mentioned there. So really starting to see that defensiveness and not really filtering through in some of those more classic risk on sectors. Financials, again, sort of the big key theme here is we've been talking a lot about that divergence and sort of the breakdown in correlations that we've typically seen.
Taylor, awesome. Looking forward to the coverage later as well with you and the team. Caroline Hyde and Romain Bostic coming up on the close a little bit later on Bloomberg TV. Taylor mentioned it. I talked about it too. Morgan Stanley have been very, very focused on this with Dan Skelly weighing in on the rotation into defensive. We caught up with him a little bit earlier. Take a listen to what he had to say. We don't have that particular piece of sound, I'm afraid to say, so we can go straight to PIMCO's Tony Kresensky. Tony, let's get to you on that. This defensive bias gripping this equity market. From the bond side of things, I'm seeing a steeper curve, not a flatter one, not an inverted one anymore. I'm seeing higher yields too. What's that speaking to, Tony?
Well, it's just a reversal of some of the flattening that we saw that had a lot to do with simply a readjustment for the outlook on short-term interest rates. And so now we see that adjustment's done, at least for now, in the market size, and we're getting the steepening that reflects what we would have said a month ago, even during the flattening we did. We had our last conversation, which is that the idea that the U.S. economy is likely to continue with its expansion with growth above potential this year. Most yield curve indicators, models suggest a recession odds of 10% or less for this year. Yes, you see articles and firms discussing 2023 with the potential for a recession being higher, call it 20 to 30% or more. But it does look like the outlook for economic growth is still sanguine, and the spread between 2s and 30s on the Treasury curve, bills and 30s and 10s especially, clearly indicate expansion should be expected this year.
Tony, you've done some work recently on the transmission channels for monetary policy. You've also been thinking about where the tipping point is for yields, and I'm often thinking the same thing. When does the sell-off start to become self-limiting? Tony, can you give us some insight into your thinking at the moment?
Well, if a bond investor had something to worry about, what I've thought about, at least in terms of the next few years, is this stair-step pattern of a boiling frog scenario where yields rise a bit, but the markets more broadly, the equity market, the credit markets, and other asset classes, show some comfort with that level. So, for example, let's say it was the rise in the 10-year yield from 1.5 to 1.75, then 2, then 2.25, and 2.5. And you did see a certain comfort level pre-war that indicated, therefore, that the burden of the tightening would be on the bond market. So there are 5 transmission channels by which monetary policy works. It's bond yields, stock prices, credit spreads, bank lending standards, and the U.S. dollar. And if only one of those things is moving, then that one thing, the bond yield, would have to move the most. Because, in other words, if equity prices are rising, that would be loosening financial conditions and helping the economy. And so there need to be an offset. And so right now, though, you see, of course, wobbling in other asset classes. It may be war-related, and certainly a lot of it is. But the burden is no longer simply on the bond market, and that is part of the steepening that's occurring because it looks like the Fed's job in terms of what it's planning to do might be enough. But we still can't know. It's much too early to say. But it looks like the bond market's saying, well, at least the burden's not on just us.
The question I'd be asking too, Tony, is the impact of QT. I just don't know the answer to that. What's the thinking of you and the team over at PIMCO? How are you thinking about just what QT means for the long end?
Good question, John. In our conversations with our advisor, Ben Bernanke, he and I described the research by Fed researchers, and we see this in public writings from the Fed even today, that it's not very clear what the equivalence is of QT. In other words, if the Fed shrinks its balance sheet, which is currently at $9 trillion, down to $8 trillion, which is what it plans for the next year, what does that mean in terms of the equivalence for rate hikes? In other words, if the Fed were to not do QT, how much more tightening would it need to do? The research suggests a wide range of figures. It could be $1 trillion might be equal to 25 basis points. It's got to be at least that. But others will say it's even more, 50 or 75. The one thing's for sure, it's probably nonlinear. So $1 trillion this year, $1 trillion in 2023, $1 trillion in 2024. The impact of those last $2 trillion could be greater than the first two. So what you have to do when thinking about the bond market and how many rate hikes there'll be is add something to the rate hikes that are priced in, 25, 50, or 75, and then start to decide whether it's enough. So it does look like a lot of tightening is priced in. $3 trillion, it's got to be at least 75 basis points. The market's priced for 2 3/4, 3. That's a severe tightening relative to recent history, since we've had an average of around 300 basis points of tightening for cycles. And so it's pretty significant, but it is needed because of the high inflation rate.
So, Tony, what does a PM do in an environment like this one? Do you carry more cash to take advantage of dislocations through the summer that you might anticipate? What do you do?
Well, you just saw in the previous segment, you were discussing the move up in quality, and we suggest that because clearly with a 3.6% unemployment rate, the Federal Reserve embarking on a course to raise interest rates, we're in the latter phase, believe it or not, 2 years into the cycle of this economic cycle. So you want to move up in quality. You want assets that are more liquid, resilient, portfolios are liquid, resilient, and agile. It's a broad way of saying things, but there are ways to do that. So yes, you want to hold a little more cash. You want proxies for getting credit and equity beta rather than be in assets that can be very illiquid in times of stress. And so do move up in quality. On duration, we're still a little underweight. We still see scope for yields to rise a little bit more. But some asset classes to some individuals, some entities might be becoming more attractive with these yields higher. Think about the Bloomberg aggregate 312 yield with some alpha if a manager can generate it, and many good ones tend to. That's not bad for a diversifier if you're looking at yields potential for returns in the high threes or near 4%. Not bad. And so don't try to market time the diversification benefits of bonds. This is what you, the bond investor, has been waiting for, higher yields.
Tony, been waiting a long time, and a lot of people want them higher than they are right now. Tony Presenzi there of PIMCO. Thank you, buddy, as always. Your broader equity market looks like this on the S&P, up 0.2%. Some good news, better news for Bank of America. Before today, only one positive trading day this month for that stock. We're up by a little more than 2.2% this morning. Up next, the battle to buy Twitter.
I do think this will be somewhat painful, and I'm not sure that I will actually be able to acquire it.
That conversation just around the corner.
Civilizational risk is decreased if Twitter, the more we can increase the trust of Twitter as a public platform. And so I do think this will be somewhat painful, and I'm not sure that I will actually be able to acquire it.
The battle for Twitter raging on. Elon Musk highlighting key divisions between investors and the company's board, tweeting the following: "Wow, with Jack departing, the Twitter board collectively earns almost no shares. Objectively, their economic interests are simply not aligned with shareholders." I want to touch base again with Ed Ludlow on the West Coast for a little bit more on this. Ed, just go through piece by piece how it started just last week, in the last few weeks for that matter, and where we are now.
Right, so in that clip you just saw, that was from the Thursday TED Talk, where he talked about not being sure if the bid would go through. You see we're now softer by a percentage point on Twitter, having opened higher. On Friday, Twitter, as expected, as was hypothesized by a number on the street, instituted a poison pill, right, to try and dissuade the attractiveness of that bid from Musk. He then tweets this tweet, John: "Music symbol emoji, love me tender," a reference of course to the 1956 ballad by Elvis Presley. I know you're a big fan. Either he's talking about music or he's talking about issuing directly a tender offer to shareholders. Potentially, you know, that takes us down the route of a proxy fight. There's also media reports Friday over the weekend that Thomas Bravo is considering its own bid. I put this chart up because look at where we are in terms of the volume of shares that have traded since the beginning of April. The stock's made gains and we're trading at around $45 a share, but it's still significantly below the $54.20 per share cash offer that Elon Musk has currently put in place. And I think, you know, a number of experts I've spoken to raise the question if Elon Musk puts in an offer below the 52-week average or high of $72, $73 a share, if the board could even go for it, right? They're in a really tough situation. Musk tweeting over the weekend that for the board not to put his offer to the shareholders was indefensible, but there are others out there that are saying, well, hold on, isn't Elon Musk kind of lowballing them? One final thought, John, very quick. This is one of the most traded stocks on the Fidelity platform, and I point this out because look at the past precedent with Tesla and the influence that the retail investor has. You look at that volumes chart I showed you a moment ago, you do have to wonder if the Elon army gets behind this. Do you know what I mean? Like all of the Twitter users, Tesla fans that now are buying into this stock based on the data we see from retail investors on that Fidelity platform.
Ed, that poison pill from the board, do you think that's more than just about Elon Musk? There's a view that they know that this company's in play now. And it's something he acknowledged too on Twitter actually, that maybe the bid comes from elsewhere.
Yeah, it's interesting because Elon Musk was responding as well to a tweet which had a table showing, and you can look at this on HDS Go or on the company's investor website, how few shares the board members actually hold, which is interesting. Of course, they get salaried compensation for their roles as board members, but he seemed to cast to doubt sort of the motivation behind that. The other part of that point, John, is he's making solid proposals to fix Twitter, right? There are issues that you and I know about. How many times does a bot reply to you when you tweet a market's point? And, you know, the investors that I've spoken to have basically said, you know, that whatever happens, and this is a hypothesis of Bloomberg Intelligence, someone's got to come in and do something to fix those problems, and taking it private seems the most feasible way of doing so.
Ed, great to catch up, as always. Ed Ludlow, there'll always be someone saying the office is underpriced. You can pick a point on the chart. Fact of the matter is, I think the stock is where it IPO'd at all those years ago. Ed, thank you. Elon Musk then, stepping up his criticism, not just of Twitter's board, but also of the SEC. Do you remember that back in 2018 and all that drama? Take a listen to this.
I was told by the banks that if I did not agree to settle with the SEC, that the banks would cease providing working capital and Tesla would go bankrupt immediately. So that's like having a gun to your child's head. So I was forced to concede to the SEC unlawfully, those bastards.
Bloomberg's Ben Bain joins us now, who follows the SEC and covers it for us. Ben, have we had a response from them to that?
We haven't, no, which isn't surprising. You know, it's not that the SEC, they are in a legal back and forth, continue to be with in the courts with Elon Musk, but we're unlikely to hear them respond to him calling them names or anything like that. What we are seeing is really just what started back in 2018, as you alluded to, and has really continued all the way since. Elon Musk, kind of in the path of some of the trailblazing entrepreneurs in the past, has really gone to battle with securities regulators here in Washington. And we've actually also seen something interesting with this latest bid that he's had with Twitter. This has actually become a political issue here as well. So it's beyond securities regulators. This whole free speech argument, and really what he's saying is the impetus for his desire to take Twitter private, has really gotten a lot of support here on Capitol Hill from Republicans who argue that Twitter and other social media platforms are essentially trying to silence conservative voices.
Well, Ben, do you have a view on how you think this is going to go down if that offer was accepted? Do you think that certain people in Washington would be happy? Sure, the Republicans, but the people in the White House right now, would they be okay with this?
I think ultimately Twitter, and whether Elon Musk is able to take it private or not, Twitter is going to continue to be a force in politics. It's going to continue to be important looking into 2022 and then into 2024. I don't think it's anything that a politician in the White House or on Capitol Hill is going to be able to do to prevent Twitter from playing an important role and continuing to be an important platform. I do think that there are some securities issues that Elon Musk, securities law issues that Elon Musk or any group of investors that want to take Twitter private are going to have to deal with. There are political arguments about free speech, and there are actual kind of the nuts and bolts of really securing what would be a massive deal here to take one of the most notable companies in the United States private. And they're kind of two different things. They're very much intertwined right now here in Washington as people discuss this deal. But I don't think that there's really anything from a political perspective that anyone in Washington would do to prevent this from going forward if it actually worked for investors, and if Elon Musk was actually able to pull this off, which we don't know, and he even said that he'll be able to do.
True. Ben Bain, this has been fascinating. We're going to continue this conversation. I get the feeling, I think we all get the feeling, this drama is not over. This stock is negative about 0.7% in early trading. Coming up, the market moving events you need to be watching, our trading diary. It's just around the corner with Chairman Powell speaking a little bit later this week. From New York City, this is Bloomberg. 25 minutes into the session, equities unchanged on the S&P essentially. Negative on the Nasdaq 100 by 3 or 4/10%, adding to the losses from last week, down about 3 percentage points last week on a shortened trading week with the long holiday weekend here stateside. We switch at the board and get to the bond market. Your 10-year yield backing away from the highs this morning, 282.58, yields essentially unchanged. Month to date, though, up in and around 50 basis points. A big move going into Chairman Powell later this week. Let's get to the trading diary, shall we? Fed President Jim Bullard speaking at 4 p.m. Eastern. Netflix kicking off tech earnings after the close tomorrow. The beige book from the Fed out on Wednesday. Then the big one Thursday. Chairman Powell and President Lagarde of the Fed and ECB respectively speaking together. And finally, another round of jobless claims too. From New York City, good to be back at the seat. Good to be back with you. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Monday, April 18th. Here are the top market stories we are following for you at this hour. Recession risk. Goldman Sachs puts 35% odds on a U.S. recession over the next 2 years. There's growth jitters in China, too, after weak consumer spending data overnight, and the World Bank cuts its global growth outlook to 3.2% this year. That's a wrap. Bank of America closes out big bank earnings with a beat on net income, record advisory fees, and 0 days of trading losses. Lending picks
Stocks up 2, and executives say consumers are still showing resiliency. And love me tender. That was the tweet from Elon Musk over the weekend that has investors' heads spinning. Is it a reference to a potential tender offer to Twitter shareholders, or has he just been listening to Elvis on repeat? From New York, I'm Kaylee Lyons. Guy Johnson is off today. It's Easter Monday in Europe, and most major markets there are closed. Welcome to Bloomberg Markets. And while a lot of the world is still on holiday, there is a lot to cover as U.S. trading is just about half an hour underway here in the U.S. And one of them is concerns on recession. Jan Hatzius of Goldman Sachs, as I mentioned, saying that here in the U.S., the odds of a recession is about 35% in the next 2 years. So that brings us to our question of the day. What is the biggest threat to U.S. growth? We're joined now by Tom Orlik, chief economist at Bloomberg Economics, and Romaine Bostick, co-host of Bloomberg Markets The Close. Tom, I'll come to you first. What's your answer?
So it's a bit of a strange position for the US economy, Kaylee. On the one hand, unemployment is low, wage growth is robust, household balance sheets are very strong. On the other, there's all of this talk of recession, and you mentioned the Goldman Sachs call there. Where's that fear coming from? Well, I think there are some challenges at home and abroad. At home, the Fed is going to have to hike rates very aggressively to bring inflation under control. If you look at the history books, there aren't too many examples of the Fed embarking on an aggressive tightening cycle without pushing unemployment up and triggering a downturn in the broader economy. Abroad, of course, Russia's invasion of Ukraine remains a significant risk, could well tip Europe into recession with spillovers to the United States. And as we learned from China overnight, COVID lockdowns starting to have a big negative impact on the world's factory, some big risks from there as well.
Tom, just quickly on that China data, can it be believed?
So historically, there's been a lot of questions, a lot of raised eyebrows about China's economic data. Now, in 2020, to many people's surprise, they actually did a pretty good job of capturing the intensity of the COVID lockdown back at the start of the year. They reported a big contraction in consumption, investment, industrial output, and GDP. Fast forward to where we are in 2022, the data for the first couple of months of the year did raise some eyebrows. It looked unreasonably strong. But they've come out now and said consumption is contracting, services are in trouble. So I think it's difficult to treat the Chinese data with the same degree of trust that we treat data in the United States and Europe. But is there a greater willingness to report the reality than perhaps there was a few years ago? Well, so far in the COVID crisis, I think the answer to that is yes.
All right, but still maybe we shouldn't take everything at face value. Romaine, to bring you in here, what influence does China have on the U.S. growth outlook?
Oh, it has a huge influence because when you talk about the inflationary pressures that we're dealing here on the manufacturing side with regards to consumer durables and pretty much everything in between, a lot of that, of course, is directly tied to the output coming out of China, whether you're dealing with the situation at the ports, whether you're dealing, of course, with the longer-term ramifications of a slowdown in capacity. And in fact, the gap that you're looking at, the economic gap that you're looking at in China has the potential to actually slow down that output. And if that does materialize, you're going to find companies here in the U.S. are going to continue to have to charge more for products, and the end result of that, at least if you believe the economists, is that that's going to cause a tamp down in consumer demand.
But at the same time, on the consumer, Romaine, while we're hearing these warnings from economists, we're also hearing from bank executives saying that the consumer looks great over the last several days. What do you make of that?
I think that's true. Over the short term, though, when you ask some of those same bank economists where that consumer is going to be 1 year from now, I don't necessarily think you're seeing that same amount of enthusiasm. Right now, you're talking about household balance sheets that are certainly strong, not necessarily as strong as where they were a year or so ago when all that stimulus was moving through this economy. You have credit card balances, which are relatively intact, but you're starting to see that spending go up. That's good for now, but over the long term, of course, that diminishes the capacity of what people can buy. And then the big question becomes is, do wages keep up? And more importantly, do you have economic conditions that are favorable enough that the consumer sentiment maintains itself?
Yeah, and we just got a headline crossing from Brian Moynihan, the Bank of America CEO, saying a massive amount of stimulus is still being spent to that point. I guess the question is for how long. Tom, on that point, Is it so much a question of if a U.S. recession is coming or when it ultimately will come? And if it's the latter, when do you think it will be?
So with recessions, Kaylee, it's always a question of when, not if. All business cycles end in a recession. Will that happen this year? I think the answer to that is almost certainly no. The US economy just has a lot of momentum right now. And as Romain mentioned, households have this kind of fortress balance sheet reinforced by all of those stimulus funds they received over the last couple of years. And that means they should be pretty robust to the start of the Fed tightening cycle. If there's going to be a downturn, I think that's going to be a 2023, 2024 story when that household balance sheet is looking less robust. The impact of the Fed tightening is greater, and those risks from Russia and China have time to crystallize.
Yeah, and 2023, 2024 was also the warning from Bill Dudley, the former New York Fed president and Bloomberg opinion columnist, who had a great piece out on the Terminal today. Romain, we've talked a lot about consumer balance sheets. Let's talk about corporate balance sheets as well. What do all these concerns about growth mean on the revenue side, on the growth side for these corporates?
Well, so far so good, right? But of course, we haven't really gotten into the real heart of earnings season. We're going to start to get some of those high valuation companies this week with Netflix, but it's really going to be the next couple of weeks after this where I think we're going to start to hear from companies that are much more sort of tethered to that consumer space, the automakers, the durable goods makers, and of course, even things like apparel makers as well. Once you get a read here on how much their costs have gone up, the second big question is how much of those costs have they been able to pass on to the consumers? That's going to be the big question. And I think when you look at some of the research that we've gotten out of Bloomberg Intelligence, the folks over like Gina Martin Adams, they seem to think that we will start to see companies be able to sort of either shoulder that burden themselves or pass it on to the consumers with a minimal loss in revenue or revenue growth.
So what are we seeing in terms of margin estimates then for the remainder of the year? Not even just the first quarter, but what do they look like looking out further?
Well, you still have estimates for margin expansion for the current reporting period, so for effectively Q1. Once you get into Q3 and Q4, there's expectations that you'll start to see a little bit more margin contraction. I'm talking at an aggregate level for the S&P 500. The question is how much contraction will you see, and will that be enough to knock valuations down further than where they already are?
All right, Tom, I want to ask you maybe an unfair question. I was speaking to Matt Maley at Miller Tabak earlier this morning on Early Edition. He said basically if a Wall Street economist puts 35% odds on recession, he really means it's greater than that, that they're always going to play it down to some extent. Do you think that the odds put in place are too low? I know you said it's more likely a 2023 or further out story. But is the odds of that happening in the next couple of years higher than maybe anticipated?
So recessions are, whilst all business cycles end in a recession is also an unusual event, which is almost by definition brought about by a shock that we can't foresee. Right? If a recession was triggered by something that we could foresee, then presumably we'd be smart enough to move monetary policy or move fiscal policy in a way which prevented that shock from occurring. So could a recession occur this year? Absolutely, a recession could occur this year. Fed tightening could trigger a big adverse reaction from financial markets. Russia could cut off all Europe's gas supplies, triggering a European downturn and tipping spillovers to the rest of the world. China could go back into a national lockdown, perhaps combined with a real estate crisis. There are a number of risks that could crystallize. What economists mean when they say, yeah, we're putting a 30% chance on it, we're putting a 35% chance, we're putting a 40% chance on it is, yes, we see those risks from the Fed, from Russia, from China, but with US labor markets so robust, our plausible base case is those risks are not going to strike this year.
All right, Tom Orlik, we'll leave it there, but thanks so much for joining me today. That's Tom Orlik of Bloomberg Economics, and our thanks as well to Romain Bostick of Bloomberg News. We'll see you later on the close at 2 p.m. Eastern Time. Now, there is another story that we want to keep on top of, and that affects those here in the New York tri-state area. The Supreme Court has rejected a challenge by 4 states, including New York, New Jersey, Connecticut, and Maryland, on the SALT deduction cap. Of course, it was challenging that $10,000 federal deduction limit on state and local taxes, but that has been rejected rejected by the Supreme Court. So we will continue to stay on top of that story over the next couple of hours. Coming up first, though, the World Bank just cut its forecast for global growth this year. So we'll talk more about the threats to growth in the U.S. Kim Forrest, Boca Capital Partners founder and CIO, will be joining next. This is Bloomberg.
Season is here.
It's been a particularly difficult quarter.
What is the forward outlook for companies?
Bloomberg is fastest with the numbers and analysis.
Where is the value here?
There are opportunities out there.
Bloomberg, the fastest numbers and analysis you trust.
You know, everyone's focused on what's having the headline inflation and has it peaked. And I think they're missing the forest from the trees here, because what's really going on is the labor market has not been this tight in many decades. And that's the problem, because if the labor market's too tight, wages are going to continue to strengthen. And if wages continue to strengthen, we're not going to go back to 2% inflation.
That was Bill Dudley, Bloomberg Economics Senior Advisor and former president of the New York Fed, earlier on Bloomberg TV. Now let's get back to our question of the day. What's the biggest threat to U.S. growth? Well, hopefully our next guest can help us answer that. Kim Forrest, Boca Capital Partners founder and CIO, is joining us now from Pittsburgh. Kim, there's a lot of different factors at play here. You have the war in Ukraine, you have the growth outlook in China, you have cost pressures that companies are facing. Which one is paramount in your view?
All of them.
Fair enough. If you had to pick one, though.
It's a dangerous stew of stuff, right? And I think because, oh gosh, I hate to trot this out. So I have a math degree, and I had a prior degree as a software engineer, but I did a lot of math in that because it was AI, and that's essentially mathematical modeling. So the markets are mathematical modeling too. So in any kind of season, what you have to understand is the market's going to reflect a handful of items, but it's all of this stuff that's happening in the world goes into it as well. But it's shifting priorities that happen, and as an investor, that's what you have to pay attention to. Yes, some days it's inflation, some days it's earnings, some days it's the Ukraine, but overall it's that, you know, over weeks and months and certainly years, all of it goes into how markets act.
Okay, so when you put all of it together, it's not just about how the markets act, but ultimately what happens to the U.S. economy. Where do you put the odds of recession in, say, the next 18 months to 2 years? Goldman Sachs says 35%.
Sure. Well, I take the under of that. And here's why. Well, A, I'm an equity analyst and I'm hopeful for the future, so that's my bias. But what the real answer is this. I heard the Bill Dudley comments about, a small labor pool. But the fact of the matter is, companies are going to deploy technology in as many places as they can to take people out of the equation. And that's not a bad thing. It's going to replace stuff that people don't want to do anyhow, rote kind of activities. And so I think that's not factored in and can't really be factored in. Inflation cannot grow to the trees. It cannot keep growing. Markets work. Supply and demand works. When the price raises, it does its job, demand destruction, and it falls back. So you just have to have a longer view of the markets to understand that, these short-term problems in the long run are going to be problems, but not as big as we think they are today.
Okay, but Kim, you mentioned demand destruction there, which brings me to companies' ability to exercise pricing power. I want to point to the research out from Mike Wilson over at Morgan Stanley in the last 24 hours or so. He says margin expectations look overly optimistic for the balance of 2022. Given the myriad of cost pressures companies face, we think the positive effects of inflation on earnings growth have reached their peak and are now more likely to be a headwind to growth. Kim, why are you not more worried about margins here?
Well, again, I'm thinking about demand destruction. I'm thinking about the things people really want, that we think they really want, like EVs and cars. It's unclear that they're going to even be able to get the materials they need to make the batteries. And thus, people are, you can only pay so much up for that car. So I think the demand for products is going to kind of slow down. And I don't know. I can't, the math of it all is just going to work out.
Okay, so finally, Kim, with that view of the world, where do you want to be putting your money?
Well, as I started off here, tech is a great idea. And again, we're going to have Internet of Things. We're going to have companies monitoring many, many things that they can't now. Like, we'll just pick on pipelines. That's a big story this morning about, energy leaks and all that kind of good stuff. But I think the amount of technology that we're going to deploy over the next 10 years is going to make our heads spin. And semiconductors is probably a pretty good place to start for that.
All right, Kim Forrest of Boca Capital Partners, we have to leave it there, but thank you so much for joining me on this Monday morning. Now, speaking of technology, I want to focus on one in particular. That would be Twitter, which has made a lot of news thanks to Elon Musk over the last week or so. Elon Musk just tweeting that his board salary will be $0 if his Twitter bid succeeds. And of course, Elon Musk also tweeting cryptically over the weekend about Tender, love me Tender. What does it mean? We're going to dig into the details, give you the latest on this continuing saga next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishka Gupta. There's a new twist in the battle between billionaire investor Kyle Icahn and Southwest Gas. The company says it has received an indication of interest well in excess of Icahn's buyout offer of $82.50 per share. Southwest will now explore a sale of the company and other options. Last month, Southwest's board called Icahn's offer inadequate. The Evergreen marine container ship that was stuck in Chesapeake Bay mud off Baltimore for more than a month is moving again. Several attempts to free the ship using tugboats failed, so salvage crews offloaded some containers to lighten the load. And is Elon Musk just messing with investors? Over the weekend, he sent a tweet with just 3 words, "Love me tender." It could have been a reference to the Elvis Presley song, or it may have been a cryptic reference to a potential tender offer to Twitter shareholders for control of the company. On Friday, Twitter adopted a poison pill provision that would make it harder for Musk to acquire more shares. And that is your latest Business Flash. Kaylee.
Ritika, thank you. Well, Elon Musk making more news just moments ago. He said board salaries would be $0 if his Twitter bid succeeds. And he says that will end up in savings of about $3 million a year. Bloomberg's Ed Ludlow is joining us now for more. So Ed, just give us some context around the statement.
Yeah, so Twitter's board of directors earn a salary, right, as part of their compensation for a part-time position. It ranges from $200,000 to $300,000 per year. And over the weekend, Musk actually responded to a tweet which showed a table of that board of directors, not just their salaried compensation, but also the relatively thin volume of shares that the board held. And, you know, his point being that no matter how fractional, I guess, $3 million is in the scheme of things for the company, that compensation would be trimmed if he were to be successful in a takeover bid.
Yeah. Well, the operative word there, Ed, is if he is successful. And obviously he had his cryptic "Love Me Tender" tweet over the weekend as well. Probably a not so subtle signal, but what are his options on the table, inclusive of potentially a tender offer?
Right, and I just point out we're now up 4% on Twitter stock, having opened higher, then dropped into negative territory, you know, so there's volatility here. Remember on Friday that Twitter did go through with instituting a poison pill. Effectively, what that would allow the existing shareholders to do is buy more shares at a fraction of the cost to have a dilutive effect against the hostile or takeover party, in this case Musk. So he could tender an offer to shareholders directly, right, to buy their shares at a certain price at a certain time. There was a lot of hypothesis ahead of the long weekend that would be the case. So it's not hugely surprising. Whether it's successful or not, we don't know. I mean, ultimately, the board has to consider one thing we haven't discussed, Kaylee. We're trading at $46 a share. The current bid is $54.20 a share. That's pretty significantly discounted to the 52-week average or high of $72, $73 a share. So one theory out there is that this is a lowball offer and that, you know, the board might sit strong, right? They might hold tight because they don't think this is in the best interest of shareholders if there could be a higher bid. And one other hypothesis is that private equity comes in, right? Bloomberg reporting Friday morning, for those of us off, that Thomas Bravo is considering a bid of its own. Maybe they team up.
Well, so Elon Musk potentially could get a partner even though, Ed, he has adequate funds to buy Twitter at essentially whatever price he would like to.
Yeah, so during the TED Talks on Thursday, he said he had, you know, the necessary financial assets to make it happen. He kind of expressed doubt about whether it would or would not happen. But, you know, after leaving the stage, we've just had a constant stream of tweets. And then the common thread of those is basically that Elon Musk feels it would be indefensible for the board not to take his offer to shareholders, you know, that it wouldn't be democratic or it would be against their fiduciary duty. So that's what we're waiting on. One thing, though, to watch for, if he does tender an offer direct to shareholders, that would come in the form of a regulatory filing. So just like you and I, everyone should be getting up extremely early in the coming days to look out for that.
It's brutal. I don't wish that on pretty much anyone, Ed.
Right.
Finally, big banks have taken sides in this fight. How significant are the sides they have chosen?
Yeah, I mean, it's interesting, right? Again, it's a hypothesis, but Elon Musk is one bidder. We know that private equity might come in. You have Goldman Sachs and JP Morgan on either side, Morgan Stanley on either side of this dispute. The wild card is how many other social media giants or investor groups are now phoning their bankers and their lawyers saying, why don't we get on the act? Why don't we make our own offer? And that is another consideration out there, that there could be a rival bid, not a joint bid with Elon Musk, but a competing bid separate to his own.
All right, Bloomberg's Ed Ludlow out in San Francisco. We'll leave it there. Thank you so much. And as Ed mentioned, Twitter shares up about 4% in the first hour or so of U.S. trading today. Now coming up, we were just talking about the banks involved in this saga. We have to talk Bank of America as well. Wrapping up earnings for Wall Street's big banks. Their loans are back to pre-pandemic levels. Big beats on trading. We'll talk about the results with the former Barclays CEO, Bob Diamond. This is Bloomberg.
This is Bloomberg.
We're about an hour into the U.S. trading session. Bloomberg's Kriti Gupta is tracking the moves. And Kriti, you and I are working today. A lot of people around the world aren't, though. So volume's pretty light.
Volume's pretty light. I think in the last 5 days, if you compare that 5-day volatility, you have about 13% of volume. So really, you are seeing some mixed moves. That doesn't mean there's no volatility here. You are seeing markets opening in the red, but then ultimately coming up back into the green. It really shows you how the defensive bid is leading higher, with the Nasdaq 100 outperforming the S&P 500. But I think a lot of the action is going to be in in the bond market, in those economically sensitive sectors as well. That's why you see a little bit of weakness in the Russell 2000 and the bond market flat on the surface. But take a look at what it's doing when it comes to the ETF space. TLT, which is of course the longer-term Treasury ETF. Check this out. In the last month, it saw a pretty big inflow. So now it's kind of counterintuitive, right? If you see a massive bond sell-off, why is the ETF seeing inflows? And a lot of it has to do with that rebalancing that you saw at the end of the quarter. The question is, if you continue to see yields higher, do you start to see more rebalancing necessary or coming at the end of the second quarter? So that's going to be something we're going to keep an eye on. On the macro front, Kaylee, let's talk about the micro front here. Didi is one of the main stocks to be watching if you want to take a little bit of a break from, say, Twitter and Tesla. Didi actually taking quite a bit of a hit this morning, down as much as 20% in the pre-market. And this, of course, comes after they are shooting for a meeting on May 23rd, talking about finally delisting their shares from the New York Stock Exchange. Kaylee, we know that a lot of the geopolitics surrounding that delisting has been ongoing amid tensions between the United States and China. Didi, perhaps the first to delist from the New York Stock Exchange.
All right, Bloomberg's Kriti Gupta, thank you so much. So that's what's going on in Chinese tech. Let's talk about what's going on with American banks. Bank of America has joined its Wall Street rivals on capitalizing on market volatility. At the same time, lending increased in the first quarter, but CEO Brian Moynihan says consumers are still watching their money closely.
The consumers are sitting on lots of cash. Why is this true? Well, you know, high wage growth, high savings, limited by limited enabled spending. But what it means is a long tail to consumer spend growth.
For more on Bank of America's earnings, Bloomberg's Sonali Basak is with me now. Sonali, what were the big takeaways for you?
Well, a few things with Bank of America is where consumers were spending. You see a huge jump when it comes to travel, to entertainment, but less of a jump when it comes to retail and restaurants. Of course, gas prices really eating at some of that spend there, and that was a big jump as well. But when you hear Brian Moynihan talk about the future, he was asked about a recession a couple times and what that would do to consumer spending and consumer loan growth. And what executives at Bank of America were saying was that consumers were really still flush with cash. They really had a note of cautious optimism, really. Let's use some corporate jargon there. And so it was really quite a bright spot here when they were talking about the scenarios ahead. Listen, Kaylee, this was not a quarter that you expected banks to really talk about records in many businesses, but Bank of America, because of that healthy growth in the commercial businesses, loans grew much faster at the commercial side, and equities trading actually hit a record, helped by financing as well.
Okay, so the Bank of America obviously rounding us out here. You've had an exhausting couple of days talking about all the big banks' reports. When you put it all together, what was the big theme for you?
The big thing was the banks being ready for any scenario here. They're making money in volatility. The trading is holding up despite everybody's worst fears. And when it comes to this consumer growth, even if you're worried about it getting into the second quarter, interesting thing Bank of America said is that it was probably a long way. It will probably be a long way before the interest rate hikes stop being valuable to net interest income. That is the key there. That is why Bank of America stock is up today. It's because they're not as worried about a lending slowdown, even though you're already seeing some of that slowdown in the mortgage businesses where mortgages rates are much higher than they were in the last decade.
All right, Bloomberg's Sonali Basak, great work over the last few days. Thank you so much. Let's get more on bank earnings now. We welcome Bob Diamond, Atlas Merchant Capital founding partner and the former CEO of Barclays. Bob, Sonali there was just talking about the kind of line that exists between where higher rates are a good thing for banks because it means more net interest income, and the line where higher rates are actually a bad thing because it could slow down the economy and therefore loan growth, for example. How far away are we from that line?
So I think when you look across the bank earnings, Kelly, I think it's two tails. In the core banking business of taking deposits and making loans, I think there's an awful lot of headwinds. I think there's the costs of running a bank just with the tightness in the labor markets, the competition with technology monolines, and also the costs of revamping the technology in the digital economy. So I think there's an awful lot of headwinds, and I think that core banking business feels a lot more like a utility. I think it has for a while, and I think that's increasing. Certainly the positive is higher rates will be a positive. I think on the other side, those banks, and you certainly saw it with Bank of America, those banks with trading operations, if you were in fixed income currencies and commodities and really even secondary equities, this volatility, rising interest rates, a little bit more uncertainty, what a great environment for a trading operation. So I think that's the way I'd look at it slightly differently, that core the core banking business versus the trading business.
Yeah, and to your point on trading, Bank of America seeing 0 days of trading losses in the entire quarter. I think that was one of the more remarkable stats that came out this morning. So if you have your investment banking side doing quite well, the consumer side is the question. Is that why we have seen banks underperforming to such a large degree, even in the face of higher yields?
Yeah, for sure. And I think it's that core banking business. So the more it's a Goldman Sachs or a Morgan Stanley or B of A with the Merrill Lynch operation in there, or Barclays Capital within Barclays, the more you have a wealth business, an asset management business, a trading business, the better you're going to look. The more you're a core bank. And, you know, look what else happened just last week. You saw Capital Group from the West Coast selling very large stakes in European banks, where these European banks have a price to book right now below, 50%. So compare and contrast that to kind of the utility look of kind of the U.S. banks. They're outperforming the Europeans, but I think that core banking business has a lot of headwinds.
And so let's talk about whether or not the consumer is the headwind, Bob. You've heard executives, not just from Bank of America this morning, but really over the last several days, talking about a resilient consumer, a still strong consumer. Yeah. Is it so much cautious optimism or over-optimism?
Well, listen, one of the most positive things is you look forward, and I know there's been a lot of talk on the show today about the potential for recession. One of the real positives for our economy is that the balance sheet of both consumers and businesses, I don't ever remember a period where both of them were this strong. On the other hand, it's quite clear that, we have been easing monetary policy into a recovered and recovering economy. We still have Fed funds below 50 basis points, yet we have a balance sheet at the Fed that's expanded from $4 trillion to $9 trillion, during the last 2 years. So the Fed's clearly behind the curve. The Fed's clearly going to have to increase rates, I think, faster and further than the market even now is anticipating. So you have that versus the very, very strong balance sheets of consumers and businesses. And listen, the economy is not going to slow down on its own. So I think the Fed is going to have to put the brakes on a little bit more than we would like, and we'll see how this goes forward.
Can they put the brakes on to the extent you think they need to, and also execute a soft landing while doing it?
Listen, it would have been much better if, as inflation got over 2% to 2.5% to 3 to 3.5%, Fed funds brought up at that time, that rates were raised at that time, but that wasn't the case. So I do think that there's some risk that they've allowed it to get too far ahead, and that the amount that they have to raise rates right now will have an impact on the economy. We'll see. I do think that we're going to see more activity. I think the way I said it is right. I think the Fed is prepared to go a little bit further and a little bit faster than we were anticipating even a month or two ago.
All right, Bob, obviously one of the things that the Fed is looking at is the labor market, and I want to bring it back to the bank specifically when it comes to labor. You alluded to it in your first answer, but the competition for talent, how persistent do you think the pressures are going to be on the expense side for that very reason?
Listen, Kayla, we have never had, I think the statistic is right, but I think there's like 11 million job offerings and 6 million unemployed. We've never had a gap like that since we've kind of been recording these numbers. So, the talk about a tight labor market and the talk about stable prices is real. The Fed has a dual mandate. It's full employment, but we're well beyond full employment. There's really strains in the labor market. And we have the most stability, the least stability in prices in probably 40 years. So I think what the banks are facing in terms of the labor market is real. And that's why I think you have to keep a real close eye on the cost line, even in more difficult quarters. Another thing I'd say about this quarter, if you look at JP Morgan's numbers, the difference between $14 billion last year this quarter and $8 billion this quarter is almost 100% the difference in provisions. Last year, they added $4.5 billion back into income because the credit provisions weren't coming. This year, they took $1.5 billion, including some provisions around Ukraine. And I think we're going to have a much tougher environment going forward around corporate credit and provisions. And I think that's a swing. If that's correct, and you have pressure on costs because of labor, and I would add in technology and the need to compete with stable coins and digital and everything else going on in that space, I think the challenges for the core banking are real.
All right, on that note, we'll leave it. Bob Diamond, Atlas Merchant Capital founding partner and CEO. Thank you so much for your valuable insight today. Now coming up, we'll turn to geopolitics. Russian troops have encircled the key Ukrainian port city of Mariupol. We'll talk about what that could mean with retired Marine Corps Colonel Mark Cancian. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. The U.S. Supreme Court has rejected the New York-led challenge to the cap on state and local taxes. That $10,000 limit was imposed by Congress as part of the 2017 law. Today's order may encourage the states to redouble efforts to obtain relief from Congress. In the UK, Prime Minister Boris Johnson faces another rocky week following newspaper reports about the Partygate scandal. The stories say a Downing Street gathering took on the nature of a lockdown-breaking party only after Johnson arrived and started pouring drinks. The Prime Minister's office has declined to comment. And Russia's central bank says it's found no clear alternatives to the world's major reserve currencies. Sanctions left the Bank of Russia holding only gold and yuan. Before the invasion, a third of its total was in euros, in addition to investments in both the pounds and yen. That made it possible for international governments to seize about half of the bank's stockpile. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. In Ukraine, defenders of Mariupol have been encircled by Russian forces, but they have not surrendered the port city yet. With us now, Bloomberg's Joe Matthew. Joe, we also obviously know that the devastation in Mariupol has been tragic. We're talking thousands and thousands of people who have died. President Zelensky of Ukraine has invited President Biden to come see firsthand the devastation in his country for himself, yet the White House says he's not going to make the trip.
Yeah, that would be unlikely. I don't think, Kaylee, the Secret Service has a great feel about putting the commander-in-chief in the middle of a war zone, though the White House has said that it is considering sending an official or officials there as a show of solidarity, and questions about whether we would send diplomats to Lviv. I mentioned Lviv, by the way, that city to the west, because we saw the first fatalities, the first casualties of the war there earlier today, as Russia opens this new week with a barrage of missile strikes across the country. In Lviv, several of them touched down, reportedly 7 fatalities, but Russia says it has hit hundreds of targets today alone. I mentioned Lviv because, as you know, Kaylee, this is an important spot to the west, a major city to the west, about 43 miles from the border of Poland, and it's been a base, if you will, for refugees leaving the country, for government officials, and of course for media, news media. Many reporters are based there right now, so a lot of questions about what this might be leading to. And Mariupol, to your point, Russia continues to tighten its grip on that port city. There are about 100,000 civilians left there right now. Kaylee, President Zelensky says if the forces remaining in Mariupol are killed by Russia, are taken out in this war, you can forget the future of talks here. He says negotiations will likely come to a formal end. So we've got an eye on this. It would be the first major city to fall in this war and would likely mark a significant turning point for Russia.
All right, Bloomberg's Joe Matthew, thank you so much. And I'm sure you will continue this conversation later on today. You can tune into Joe on his Bloomberg radio program weekdays at 5 p.m. in New York, 2 p.m. in San Francisco. That is when you'll hear Sound On. Now, for more on the war in Ukraine, which has now gone on for nearly 2 months, let's bring in Mark Kansian, Senior Advisor for the International Security Program at the Center for Strategic and International Studies. Mark, let's talk about Mariupol first, which Joe and I were just discussing. It hasn't been surrendered yet. If and when that day comes, how significant a moment will that be in this war?
Well, the valiant defense of Mariupol is coming to an end. The Russians have tightened their grip. They've isolated the remaining Ukrainian forces. I think it's only a matter of a couple of days. But the defense has been significant. It's inflicted a lot of casualties on the Russians. It has reinforced the conventional wisdom that cities soak up armies. And it bought time so that the Ukrainians have been able to conduct a successful defense in the north and then move forces to the east. On the downside, it's going to allow the Russians to free up some forces that will certainly push north. They will try to link up with other Russian forces that are pushing from the north down to the south, and there's a threat that they might be able to cut off the Ukrainian forces in the east, expand Russian territory in the Donbass. That's going to be the next great battle in this war.
And Mark, we heard from Ukraine's Foreign Minister Dmytro Kuleba, who said the city basically doesn't exist anymore, that the Russian army has decided to raze it to the ground at any cost. Is this Russia's model now? Should we expect to see this in cities across the rest of Ukraine if and when Mariupol does fall to the Russians?
Well, there's no question that the Russians have used a great deal of firepower. That's according to their doctrine. They use a lot of firepower. They've got a lot of artillery. I think the one good thing is that the Russians have learned their lesson here. They've taken so many casualties in trying to capture the city. I don't think they're going to try this again. I think in the future they'll try to surround cities and go around them, not try to capture them. So I don't think you're going to see this level of destruction in other Ukrainian cities.
Okay, so we've talked about the fighting, Mark. What about any kind of potential end to the fighting? We heard President Zelensky say over the weekend that talks are at a dead end because they are not going to trade territory or people. Where do you put the odds of any kind of resolution through talks at this point?
Well, unfortunately, the prospects look very poor. Both sides are digging in on their positions. Putin hasn't indicated any willingness to fall back from his war aims. Zelensky had put an offer on the table at the very beginning to make Ukraine neutral and basically go back to where they were before, but neutral, give up their the possibility of joining NATO, but Putin didn't respond to that. So right now, both sides are far apart, and I don't think there's much chance of resolution. I think the war is going to go on for an extended period of time. You see that actually in the latest U.S. aid package. The United States is doing some things that indicate that, the war may go on for weeks or even months, unfortunately.
Well, let's talk about aid, Mark, since you brought it up. At this point, what does the West need to do for Ukraine? Is that aid needed in the form of weapons? Are we talking just straight financing at this point? What is your assessment?
Well, the latest aid package, I think, indicates where the aid program is going. We've been providing aid steadily at the rate of about $50 million a day, and I think you're going to see that continue. This current aid package will therefore last about 2 weeks, but it reflects a major expansion in what the United States is doing in two ways. First, it contains some Soviet-era equipment that we are getting from various allies and partners. We're doing that explicitly. The package has Mi-17 helicopters, but we're also providing T-72 tanks and I think likely MiG-29s and aircraft. But in even a larger expansion, we're providing U.S. equipment. We've never done that before. We provided some munitions, like Javelins, which have been very important. But now we're providing howitzers and armored personnel carriers. Those are needed for the war in the east and the more open spaces there, and for the artillery to counter Russian artillery. But it also requires training for Ukrainian service members because these need maintenance, they need supplies, they're much more complicated. So there are Ukrainians training in the United States on how to use these weapons, and that's an expansion since we now have Ukrainian service members and U.S. Directly involved.
And Mark, finally, to this point, there hasn't been any confirmable reports of the use of chemical or biological weapons in this war. The U.S. has promised a severe response to that if Russia would indeed use them. What would you guess that response would be when the president has committed to not actually directly put